Hello, future investors. If you're ready to take that first step into the world of investing with your initial $1,000, you're in the right place. Remember, this isn't financial advice, but a set of insights and tips to help you begin your investment journey. Let's go! Investing is a journey of financial growth and lifelong learning. Let's take a deep dive into how to smartly invest your first $1,000. Tip 1: Clear high-interest debt. Before diving into investments, it's critical to get rid of high-interest debt. These debts, like credit card balances, can grow faster than potential investment returns, eroding your financial health. With your first $1,000, you could clear off some of this high-interest debt, effectively making a return equal to the interest rate you would otherwise pay. Tip 2: Build an emergency fund. Before stepping into the world of investments, ensure you have a safety net. This fund, ideally covering 3 to 6 months' worth of living expenses, is your backup in case of unforeseen circumstances. Your initial $1,000 could serve as the starting point for this emergency fund, providing you with financial security. Tip 3: Diversification. When you're ready to invest, remember the golden rule: don't put all your eggs in one basket. Investment diversification is all about spreading your investments across different asset classes such as stocks, bonds, and real estate. This strategy can help minimize risk if one sector performs poorly. Tip 4: Low-cost index funds and ETFs. As a beginner, you want to keep things simple and cost-effective. Index funds and ETFs are perfect for this. These funds are designed to track a specific market index. They offer broad market exposure and diversification across multiple sectors and companies, all with low expense ratios. Tip 5: Consider robo-advisors. If you're unsure where to start or want a more hands-off approach, robo-advisors can be an excellent tool. Robo-advisors use complex algorithms to create and manage a diversified portfolio based on your risk tolerance and financial goals. They automatically adjust your investments as market conditions change. Tip 6: Financial education. One of the best investments you can make is in yourself. Take time to learn about personal finance and investing. Consider buying books, subscribing to financial magazines, or enrolling in online courses. The more knowledgeable you are, the better investment decisions you'll make. Tip 7: Regular savings plan. Once you've started investing, the key to growing your wealth is consistency. Setting up a regular savings plan where you consistently invest a portion of your income can lead to significant growth over time. This is thanks to the power of compound interest. Tip 8: Dollar cost averaging. This strategy involves consistently investing a fixed amount of money, regardless of market conditions. Dollar cost averaging reduces the risk of investing a large amount in a single investment at the wrong time. Instead, you invest smaller amounts regularly, averaging your investment cost over time. Tip 9: Avoid following the herd. The latest hot stocks or investment trends can be tempting, but remember, investing isn't about following the crowd. Successful investing involves careful research and making informed decisions based on your financial goals and risk tolerance, not what's trending at the moment. Tip 10: Understand your risk tolerance. This is essentially how much investment loss you can handle. Risk tolerance varies from person to person. While higher risk investments can potentially offer higher returns, they can also lead to bigger losses. It's important to balance your desire for returns with your ability to withstand losses. Tip 11: Consider cryptocurrencies. Cryptocurrencies can be highly volatile, but they also offer the potential for high returns. Do your research before diving into this relatively new asset class. Understand the specific cryptocurrency you're interested in, its uses, and its potential risks. As always, only invest what you can afford to lose. Tip 12: Control your emotions. Investing can be a roller coaster ride. The market's ups and downs can stir up emotions, leading to impulsive decisions. Stay focused on your long-term goals, stick to your investment plan, and avoid making decisions based on fear or greed. Tip 13: Regularly review your investments. Keep an eye on your investment portfolio and review it regularly to ensure it aligns with your financial goals. Reviewing helps identify any adjustments needed due to changes in market conditions, your financial situation, or your investment goals. Tip 14. Rebalance your portfolio. Over time, the value of your investments can shift, causing your portfolio to stray from its target allocation. Rebalancing involves adjusting your portfolio back to its original asset allocation, aligning it with your investment strategy and risk tolerance. Tip 15. Know the power of compound interest. Compound interest is the interest you earn on your initial investment plus the interest that has previously accrued. The sooner you start investing, the more time your money has to grow. Even small amounts can grow into substantial savings over time thanks to the power of compound interest. Tip 16. Understand the impact of fees. Fees can significantly eat into your investment returns over time. Always consider the fees associated with any investment product, including mutual funds, ETFs, and robo-advisors. Lower fees often lead to better net returns over time. Tip 17. Real Estate Investment Trusts (REITs). If you're interested in real estate but don't have the capital or desire to buy property, consider REITs. REITs are companies that own, operate, or finance income-producing real estate. They offer a way to invest in real estate without the need to physically own property, and can provide a steady income stream. Tip 18. Stay informed. The world of finance is always evolving. Staying current with financial news and trends can help inform your investment decisions. Follow reliable financial news sources, subscribe to financial newsletters, and consider joining online investment communities. Tip 19. Patience is a virtue. When it comes to investing, slow and steady often wins the race. Don't expect instant success. The most successful investors are often those who invest consistently and patiently over time, ignoring short-term market noise. Tip 20. Consider a financial advisor. When you're ready to take your investing to the next level, consider seeking professional advice. A financial advisor can offer personalized advice based on your unique financial situation, helping you create a comprehensive financial plan that covers all aspects of your financial life, including investing, tax planning, retirement planning, and estate planning. And there you have it! 20 detailed tips for investing your first $1,000. If you found this video helpful, please give it a thumbs up, share it, and subscribe for more finance and investment insights. Here's to the start of your investing journey.